The post-recession bull market is starting to slow down. That was made evident last week when the Dow had its worst single-day point decline.
Here to tell us what it means is Jim Heafner, certified financial planner and president of Heafner Financial. He's known as the Carolinas retirement coach, and he joins us every Wednesday to help us get financially fit. Jim, good morning. Thank you for being here.
Good morning.
Hello,
all right,
hello.
So we've been talking all week this week about the plunge last week. What's the first thing an investor should do in a volatile market?
Well, the first thing is not to panic. This is what the market does. So if you're panicking, it probably means you're overexposed to the market. So what I would say is the second thing to do is call a financial planner, schedule a meeting, and prepare your plan to reduce market volatility. Now, that might mean working with a top-tier active money manager to help you reduce the downside risk. It might mean if you're near retirement age or close to retirement age, having a substantial amount of money outside of the market, so when the market account's down, you can pull from that and spend from that, so you're not locking in losses. Locking in losses is the worst thing you can do to run out of money.
You know, one of the biggest things that happened in 2008, what everybody kind of knows about, is that the market just kind of sat there and crashed. So how can we use history to help us when we got downturns to go ahead and plan for the future?
A great question. So, the more we can learn from other people's mistakes, the better prepared we are not to make those same mistakes. So here's an example. Research tells us that if we look at the last 100 years of the market, and that happens in the future, and you're taking out 5% a year, there's a 66% chance that your money will not last 30 years, right? So what the reason is that when you have bad years, down years, once you're retired and you're taking money out, you lock those losses in, you lower the account value, and it can never recover. We have to have a plan for that.
We need a plan for that. Any tools that we can use to help us with the evaluation process when we're looking at the different setbacks that we have and when the market's down and up?
Well, for sure. So you can go online, and there's all kinds of online tools. Financial advisors have all these tools. The problem is most of them make a simple assumption that the market's going to do X percent a year, 5% or 8% or 10% a year. The problem is the market never does that.
It never
does this, up and down. So we need to be able to use modeling tools that really recreate reality, to go back and get any period market history and put that in your world and see how your account performs. And design your account so that you can withstand any of those situations.
So what are some other steps investors can take to help sort of crash-proof their retirement plan?
Well, so what I would recommend is that, one, you really have a financial planner working with you to design your plan to withstand all those things. But I think the first thing is to diversify. We all know diversification is important, but I mean diversify throughout the market and then outside of the market. Everyone's selling the market. Well, there's other ways to invest too, right? So the next thing would be to rethink investing. So investing is not just stocks and bonds, and that's what people want to sell you as stocks and bonds. But we want to get outside of that world in addition to stocks, and we often look at insurance contracts and lending contracts, and there are ways to really outperform the market historically with no market risk. So, and the last thing is be very cautious of bonds. Bonds, especially long-term bonds, they don't provide the value, the interest rates, or the stability they used to provide. So we've got to have a way to create our success plan, right? And look at these alternative ways of doing it so that the market is not everything to us.
Well, retirement planning can be complicated, as you know, so it's really important to sit down with a trusted financial professional like Jim Heafner. Give Heafner Financial a call. The first 5 qualified callers will receive a complimentary, no-obligation financial review. The number is 704-552-1230. You must have a minimum of $500,000 in investable assets to qualify. Again, the number 704-552-1230. Or you can visit Jim's website. It's you'lljustknow.com. You'lljustknow.com. Jim Heafner, as always, thank you so much for being here.
Thank you, sir. Appreciate it.